Hey, everybody, it's Jeff and Ron here with the Sense of Things for another weekly update on what's going on in the world, what's going on in the markets, and what's going on in the economy. This week, lots of economic news. We have leading economic indicators. We have a couple of the manufacturing indexes again. A lot of the same stuff. There's some interesting things going on in the world. So, Ron, what's going on, buddy?
Morning, Jeffy. All good. Never a dull moment. Even after the events a week and a half ago, news doesn't stop.
No, it doesn't. We're dealing with not only the conflict in the Middle East and that getting hotter and hotter, but we're still trying to get a Speaker of the House and everything else to stabilize things in Washington. So just once again, craziness, but we will find our way through all this.
I got to tell you, things are only going to get worse before they get better out there. And also Russia and Ukraine. And I got to tell you, I am shocked. I did predict oil would get to 100 by the end of this month. We'll see.
Yeah.
But I just don't understand how we didn't take a bigger hit in the market.
Yeah.
In the last 10 days. I get, hey, focus on where we are, but there's going to be contagion here. This thing is going to spread.
Yeah.
And I just don't understand how people are just basically ignoring what's going on outside of our borders.
Yeah, but I don't think they can. I don't think they can ignore the bond market, and the bond market is signaling ugly at this point. Rates going up like crazy. So once again, they're not the most exciting people in the room, but bond traders tend to be the smartest guys in the room.
And the bond market always leads the stock market. Yep. That's been forever.
Yeah, and I think they're signaling, hey, this is gonna suck. And it's going to get way worse at this point. And I think rates going up, it just keeps continuing to beat on what used to be the safety part of most people's portfolios.
If you're holding it to maturity, it doesn't matter.
Yeah.
Right. And one of the frustrating things that I have found listening to financial TV, which is why I've always said that the best way to watch it is on mute.
Yeah.
Is that they're focused in on the risk with treasuries. The only risk with treasuries is if you get in now and you may sell before maturity date and it goes down. Correct. If you hold on to maturity date, it's risk-free.
Yeah.
So what's the risk? The average investor is not trading a treasury unless they needed the money.
Yeah.
So you shouldn't go that far out in duration. So I don't understand why they keep pushing treasury risk when if you're holding on it to maturity, there is no risk.
Yeah, and same thing, junk bonds and everything else. There's a little bit of default risk in junk bonds, but that's been significantly less here lately, surprisingly. It's been significantly less in that aspect. I think we can kick off a little bit. Let me go over a few of the economic things that I saw this week as I was looking through Econoday. Let me just, hang on. Make that go away. Stop sharing. Hold on. Let's share the correct thing this time.
How you cut that out?
All right. Some of the things I just saw through Econoday this week, we're looking at Empire State Manufacturing Index for, I think, the 9th or 10th month has been in the negative, and it's just not getting better. It's not horribly down every month, but it's just this continuing thing. Philly Fed, same thing. Philly Fed did accelerate a little bit this month. I think it was down like 0.7, or no, it was actually down 0.9, 0.13, 0.5 last time, or 13.5, down 9 again. So it's just continuing to be this manufacturing index going down. So they're signaling something from that aspect. Retail sales,
manufacturing less goods to be sold.
Yeah, I just think they feel like, okay, we're anticipating that somewhere out here, we're going to have a contraction in the economy, and we just don't want to continue to manufacture and build inventories someplace else from that perspective.
Okay.
Retail sales were actually up. They were actually up from the prior, which was 0.6. They're up 0.7 this time, above the consensus range, above what the consensus was, which was 0.3. So that's still, we keep saying it, but the consumer's still there, and the consumer's still buying things at this point. And
a lot of that could be related to back to school sales too.
It could be, yeah, because this was September. So that really could be at that point, but still strong. We heard a lot about, well, people are
Still spending.
economizing and everything else, but it's
They're
still strong.
they're spending on their credit cards and they're
Yep.
carrying over the balances.
Yes, at 22% or whatever it is. So just insane. Housing starts and permits. I know you're going to talk a little bit about mortgages. Housing starts and permits kind of remaining about where they've been, a little bit better this month than the previous month. Just continuing that part of the economy, which is good because that means we're, housing starts, that's new houses and everything else. And of course, jobless claims were down, and we'll talk about a little bit about that in the leading economic indicators. That was the only bright spot, I would say, of the leading economic indicators from what I could see.
Yeah. Yeah, look, people are still hiring. People still got jobs.
Yeah.
They're still spending, but as we saw with credit card balances breaching $1 trillion a couple of months ago, that number is not going down. It's still going up. So
yeah, and I'm
spending, but they're spending money that they don't have.
Yeah, I'm interested to see with this jobless claims as the UAW strike continues to go and go, how long the strike fund is going to hold out and when those folks are going to start filing for unemployment at some point in here.
Yeah, I thought they could. Even though no, they can't because they didn't.
No, because the strike fund's basically paying them a wage. It's not full wage. These guys aren't like partying on the beach somewhere during this time period because they're making less than they normally would make. But I mean, at some point, the strike fund's going to start wearing out, and then from there, it's now you're dealing with more and more people dumping on to the.
Yeah, I got to tell you, I'm going to plead ignorance. I haven't really kept up with the UAW situation in a few weeks.
Yeah.
Have they backed off the 40% raise or the 30% raise in a 4-day week yet?
No, and I believe people should be paid for their worth, but I think the fact that from what I'm seeing from UAW is they're just absolutely not going to budge an inch. They just refuse to budge an inch where the car companies are coming with, how about this offer? No. How about this offer? No. And there's
they got to deal with 3 different car companies.
Yeah. Yeah. It's to the point where it's okay, guys, you're gonna have to budge a little bit because you're not negotiating in good faith. You're just like, okay, I'm digging my heels in. It reminds me of Washington now. I'm digging my heels in and I'm not gonna negotiate at all because they seem to think that UPS got this great deal, so everybody should get this great deal. UPS's deal, although it appears like it was so great, it wasn't. I've got a UPS guy that's a good friend that comes into the office all the time, and he was like, this whole talk about all these drivers making like 150 grand a year. I want to know where that is because
actually, I do have a client that works for UPS pretty high up. What he said is 170,000 is the total comp package with benefits and overtime and things like that. On the top end, that's where it is.
Okay. Yeah. But still, I'm like, all right, theoretically, yes, but most of these guys are not making they're not making a fortune. They're doing their jobs and they get paid decently, but some of the stuff with I want people to get paid what they're worth, but there's a point where you start to hurt the companies. And there's this whole belief, it's the guys that run the company, they're making all this money. And I'm like, yeah, but the people who actually own the company are the shareholders. And those are like teachers and pension plans and all that.
Don't forget, and I know I mentioned this before, to the worker, there's no risk to them with the company. Guess what? Company goes under, they go get another job.
Yeah.
But the more that they push up wages, which is the largest input cost, that means the cost is going to get passed on to us. And then that means that the earnings will get shrunk, which means the stock price will go down. So who does that behoove in the long run?
Yeah.
That's why I always believe with the unions, right? Not the unions, but the employees themselves, they should be getting stock.
Yep.
So this way they understand that, hey, the better that you do your job and everything else, the stock will go up. And that's how you could also build wealth. But they don't want that risk either.
Nope. No, not at all. They would rather the pension plans and all that take the risk. And it's okay. It's the reality is, there is no risk to the employee. Really, whatever they get out of this is going to be better than what it is. And I think the other side of it, the argument, they're going to be building more electric cars and that it won't have as many employees as all this. And I'm like, that could be a reality. But the reality is, yes, they're starting to build a lot of electric cars that people don't want.
The real interesting union thing, and then we can move on to LEI,
Yeah.
is going to see after this is resolved with UAW, who's next, right? I'm not talking about the culinary strike in Vegas or whatever. It's Amazon.
Oh, yeah, there we go.
Because if they end up unionizing truly across the board, it's gonna be tough sledding for the consumer. That's all I can say.
Yeah.
Because Amazon and Walmart right now are bringing it down the cost of everything as far as I'm concerned, and obviously convenience is a part of it.
Yeah.
But if the unions get their claws into that, there goes the moat, the edge for these companies.
Yeah, exactly. And that's something that you really can't control the wages at that point. And that the more the wages go up, the more my prime charges are going to go up and the cost of everything related to what I do. And I'll be right there to say there's so many times I go out and I'm looking at the local, I'm looking at the local place where I shop and I'm like, okay, there's nothing that I want here. Boom, Amazon's got it. And it'll be there probably before I get there.
Just out of curiosity, do you know how much Prime is now? I know when I started it 11 years ago, it was $59 a year. Isn't it like 150 or 160 now?
Yeah.
Or more? Is it more? I don't know.
No, I think it's 159 or something like that. But trust me, I put a hurt on it every year. So
I don't know. I get my money's worth too.
Yeah.
But at the end of the day, with unions or whatever, the Prime is going to be over $200.
Yeah. Probably.
Because that's the only way they could do it if they're still trying to get people to the website.
That's exactly right. Yeah, because they can't get it really on the transaction cost side of things. So it's just going to come out of us. And when's the next one? Then it's Costco. Then it's blah, blah, blah. All these different things at this point. So
yeah, I hear you. All right, let's move on to LEI. I'll let you kick it off. I know you had a chance to review it when it came out this morning.
Yeah, so I think, the big thing that I saw from this, and certainly your input, the big thing I saw is pretty much there was only one, what I would consider a good part of this one, which was the unemployment rate. That's the only real positive. It's the only thing, everything else was either neutral or negative at this point. And we're continuing to go down on the LEI side of it. The only thing that's holding us away from completely signaling a recession at this point is the GDP. And who knows what those numbers are going to be. Once again, I've said this before, I still think we're probably in the beginnings of a negative GDP period. It's just it hasn't been reported yet.
It's funny you say that because it was either last podcast or 2 podcasts ago, we saw the Atlanta Fed had an absurd GDP growth number. They just increased it in the last week.
If you're wrong once, just double down on it.
I guess. But you're right. The LEI did tick down. It flattened out a little bit, which, couldn't go down in a straight line, which it looks like it did, but it did tick down again. And on the right side here, I'm just going to ride your coattails of what you were talking about with manufacturing.
Yeah.
The ISM orders. That is the aggregate of all the manufacturing in the country, and it was down again.
Yeah, and that one's accelerated. That's, if you looked at 6 months ago, that was like a -1 or something like that, or negative like 0.95. So it's just continuing to accelerate. And I think that tells me that that's the first straw. The second straw is going to be on the unemployment side of people. Okay, these manufacturers going, okay, well, we're not making as much stuff, so we're gonna pull down. And it's interesting to see, and I would assume in that number is the 3 major car companies, because they should be manufacturers. Is that going to accelerate, which then indicates, okay, the unemployment figures really start to increase dramatically.
Yeah. I mean, you and I are picking out the same things as typical, but I will tell you the one thing that I've been talking about it for months. I was talking to another advisor friend of mine that if the 10-year breaches and stays above 5%, a lot of people look at that's the crack you're falling through the ice.
Yep.
Now, we hit 4 4.96 this morning. I saw it very early this morning. I don't know where it is right now, but I know it was hovering above 4.9. So we may go above 5, pull back. But if we stay above 5, I heard a couple people talking about 5 or 6.
Yeah.
Some key people that I do listen
I think
to.
5 is a psychological number too.
It's a big round number too.
497 doesn't sound as big as 5 does. And you start looking at, okay, I've got a riskless return of 5. Okay, well, I've got a client that we just moved some money into a money market account for him that he was sitting in a Chase account making like point nothing on $1 million. And just to make the first step of getting some stuff moving, we moved over to a money market at Charles Schwab making 5.25%. That's literally, we did the math, or he finally started doing the math in his head, and he's like, crap, that's like a freaking trip per year. It's like a lot of travel per year, and I don't have to do anything for it.
And this is why they say the small and medium-sized regional banks are in trouble.
Yeah.
Because people are pulling their cash to go to the higher yield money markets or the treasuries. So they don't have the deposits that they need or the cash in there that they need to lend out, which just goes into the whole cycle of the credit tightening, and not as many loans are free flowing out there.
Yeah. Right. I think when I look at this LEI thing, the LEI chart too, the other green shoot or the other positive was the S&P 500. And to your point at the very beginning of this, that we were talking about today, it's just shocking to me that all the craziness that's going on in the world, in Washington and everything else, and the S&P just keeps pounding through. Like I said, the only thing that's really had an effect on it has been the last couple of days, the bond market going, whoa, hey, hold on, something's bad going on here. And that all of a sudden puts the brakes on the S&P.
There were some underpinnings with the bond market at the end of last week, the beginning of this week. They tried to do a 30-year and a 20-year auction, and they fell flat, meaning that there wasn't the demand that they thought there would be. And that's what sent the market down.
Yeah.
So we'll have to see. They're still trying to raise more money to help pay for these geopolitical events and everything else. At some point, I know Janet Yellen came out and said, they got plenty of money. They got plenty of money to support Israel and Ukraine and everything that's going on in the U.S. That's fine if you keep printing money, but if nobody's buying the treasuries, that's not good. All right.
Yeah.
So
you actually
the other thing I thought
money.
was a little disturbing is when you see moves like this is when you got to just pause for the cause. The mortgage, the 30-year fixed rate was 7.57 1 week ago, and it breached 8% yesterday. How many people are buying houses?
Yeah.
I understand you can refinance in 3 to 5 years. You got to still shell out, depending on what kind of a house you're buying, another $200 to $400 a month until the mortgage rate gets below 5 or 4% again.
Yeah.
So you're shelling out all this additional money just for interest that isn't even going towards your equity.
Well, and the thing is, housing prices have still remained stable going into that. That's the interesting part.
That's because there's no inventory.
Yeah.
People want to sell their houses, but there's nowhere for them to go at 8%.
Yeah. Yeah,
so
it's intriguing. But yeah, it's scary. And it's been a long time since it's been up there in that range. Was what, 2001? Which, I mean, to me, it's shocking. I didn't even remember it was up around 8 in 2001.
Quite frankly, during the craze of the housing market, I'll be blunt. Until I looked at, excuse me, a few charts a few weeks ago, I thought it was at 7 or 8% back in 05, 6, and 7 when the mortgage people were just going nuts with housing.
Yeah.
I didn't realize that it has been 22 years.
Yeah. That's scary.
All right. So then the next thing is shifting gears off of some of the wonderful economic news that we always decide to chew on every week, is just talking about just portfolio management for the long term.
Yeah.
And I thought this was interesting because I've seen these charts over the years, but even doesn't matter whether you're talking to a 20-something or a 50-something. They've got to know the numbers, meaning that if you're invested in high quality positions, even if it goes down, you should still be adding. All right, it's on sale. Compound your returns on the upside. But people that want to get in and out of the market, I think this is just very telling on its own.
Yeah.
So if you invested $10,000 over the last 42 years, but you are going in and out of the market, and you may have missed 5 or 10 or 30 of the 50 best days since then, right? Look how much your returns would have decreased over the last 42 years. If you put in 10,000 and just said, okay, I'll reinvest the dividends and we'll just keep
just leave it alone. I'm not going to think about it. And that's what I tell clients. If you're gonna invest yourself, it's like invest in an index and then don't monkey with it. Don't even look at it. Just let it go. And there will be times, yes, there's going to be 2008 when that goes down 40% or 30% or whatever. There's two decisions every time you trade out of that. There's the decision on when to get out, and then there's the decision on when to get back in. And what I will say is a lot of people timed okay. I would say in 2008, a lot of people timed the get out part okay. They saw it going down and they got out. But I remember clients that we were talking to that were 3, 4, 5 years down the road and were still sitting in cash or still sitting in bonds or something at that point. Most of them just went to cash.
Right.
And then sat there and missed out on the recovery time.
Look at COVID. Everybody was scared crapless, right? When we hit a low of March 23rd of 2020. Right. We went down 30% in a straight line in 6 weeks. People thought we were going down another 20 to 30%. Look, I had a client that got out 2 days before the low. He couldn't take it anymore. And he took him 6 to 8 months before he wanted to get back in. Now, he suffered. He absolutely suffered because of what he lost. And when he got back in, he had to pay a higher cost basis. So, but even so, I get it, right? It's emotional. It's pain. I got to get out. But for the long term, it works out. So maybe there are some things you could time, but to do a wholesale change of in and out makes no sense at all.
Absolutely. Totally agree.
Yep. So my last chart here is about recessions. Going forward with not trading your portfolio, even with recessions. When you look at the last 11 recessions in the last 73 years, even if you kept adding on the way down, and certainly we all know the escalator up and the elevator down and the escalator up and the elevator down. We've all seen this happen multiple times, but the idea is that just keep adding to the quality positions over time, including if you're in a good index fund that's mirroring the market moves or better, you're compounding your returns if you keep investing right through the recession versus I'm going to sit on the sideline. And of course, we're not talking about a 65 or 70-year-old person because they're in a different mode, but we're talking about probably people 50, 55 and under that still have another 10 to 15 or 20 years to go.
Sure. I think the reality too is, they've got that time to go, but they've also got, let's say they're 65, you probably have got another good 20 years at that point on top of that. So you can't get too conservative too fast. Yes, you need to start, positioning your portfolio for income, but you still need to have growth in your portfolio because inflation is just going to eat you alive over time. And then if you go through a couple of years like we've been with the bond market where that's eating into your principal or whatever, because most people don't invest in individual bonds. They invest in bond funds or whatever, and they're getting walloped right now because there is no hold until maturity on that stuff.
No, and you got to look at, people have a very short-term memory when it comes to investing. So if you look at the last 23 years, we've gone through 3 recessions, right? We went through a deep one. It felt deeper. I know it felt deeper for me in 2001 and 2. Obviously, the financial crisis and the COVID blip for about 6 months. So people have been spoiled and they know what happens, but they see what occurred. People are spoiled because look what happened between 1970 and 1981. There was 4 recessions. Right? People thought we were just didn't feel good about ourselves. We were never going to expand again, things like that. And then we deregulated with Reagan and everything else. And then you see what happens. But I think people are just quite spoiled with what they've seen, that they're just not riding out the binge and purging of the credit markets during these cycles.
I think you look even this chart you've got up, you look at the amplitude first off of the markets during these time periods and the extended periods of time much longer than it used to be. There used to be these much more regular cycles. And I think part of that is, Fed's management of capital, kind of them monkeying around with the system a little bit. And it just becomes the bad times get worse and the good times are good, but the bad times get worse because there's higher amplitude in those cases.
Yeah, no, I just think these charts are just excellent reminders to everybody about long-term investing.
Yep.
Trying to disconnect the emotional cable between yourself and your money, which is very difficult for anybody, including us. But I think people just need to look at that. And you can have a balanced portfolio and still do well. You don't need to be high growth all the time.
No.
But even balanced portfolios will still mirror the market to some extent.
Yeah, absolutely. And there is some adjustment to portfolios that I do with clients. We have a trading strategy that we use that kind of looks at momentum indicators and things along those lines. And the interesting thing is it's been that indicator has been pretty conservative this month, even though the market has really taken off, but it's certainly making us look like heroes as the markets pull back here this week.
Yeah, I think we need to talk about portfolio management every now and then.
Yeah.
Looking at the big picture, not just what's right in front of us.
Yeah. And like I said, once again, if you're doing this on your own, you shouldn't be, if you're not going to put in the time, first off, and decide on a strategy that has pretty consistent, if you can track a strategy and say, hey, it has consistent wins, you don't have to be a 700 hitter, but you need to be positive more than you're negative in those cases. And if you've shown that you're not, and most people don't really track what they do, they just respond on emotion and they don't really look at the numbers, that's going to come back to bite you in the end. And you're going to end up in that missing a few days here and there can be a dramatic difference. Just missing 30 days over 30 years costs you 30 days in 30 years. So that's 1 day per year that you missed during that time period and cost you about $500,000.
Yeah.
Doing that.
Yeah. No, it makes sense.
All right, guys, as always, we do these every week for you. Make sure that you are giving us a thumbs up. Love to hear your comments on what's going on. Please share that with us. We are on YouTube, and within the next month, we're also going to be on to the podcast channels. Make sure that you keep an eye out for that. It'll be a place that you can also just hear us. You won't be able to see anything, but you'll be able to at least hear us on that. So thanks a lot, and we'll see you guys back here the very next time.